Well, all right, everybody. I'm Logan Alec. I'm a CPA, and in this video, I'm going to talk about how dividends are taxed. Now, if you've taken my course, link in the description below, you know why I'm not personally a big fan of dividend stocks. But inevitably, whether you're an intentional dividend investor or not, chances are that you will own at least some security, whether a stock or an ETF or an index fund that pays dividends, which you should report in your tax return. And if you received $10 or more in dividends from any one brokerage last year, that brokerage has likely sent you a Form 1099 dividend for last year. It will likely be in a combined PDF with your Form 1099B from that brokerage, as well as your gain loss statements, which shows all your stock sales for the year. So here's an example of a Form 1099 dividend I received from M1 Finance last year. This is a brokerage through which I've been dollar cost averaging into small cap and mid cap stocks for a couple of years now. Check out the link at the top of the screen if you haven't yet seen my M1 Finance review yet. There's also a welcome bonus link in that video. But here's a 1099 dividend, and for purposes of this video, I'm just going to focus on the top two lines, line 1A, ordinary dividends, and line 1B, qualified dividends, because that's the lines that most people have in their 1099 dividend when they get one. So I'm going to explain what ordinary dividends are, what qualified dividends are, and how they are taxed. Some of you may have foreign tax paid on line 7. I'll probably want to tackle that in a separate video. But for this video, I'm only focusing on ordinary and qualified dividends. First thing you need to know is that the amount of ordinary dividends on line 1A is the amount of all dividends you've received during the year. So yes, it includes the amount of qualified dividends on line 1B. So if all your dividends are qualified, and I'll explain what that means momentarily, if all your dividends are qualified, then line 1A and line 1B will be equal. If some of your dividends are qualified and some aren't, like in my case here in my 1099 dividend, then line A will be greater than line 1B. But line 1B will never be greater than line 1A because line 1A includes dividends included on line 1B. Now, what's this whole qualified dividend business? So qualified dividends, and I'll explain this in greater detail later in this video, qualified dividends qualify to be taxed at the reduced capital gains tax rates, while non-qualified dividends are simply taxed at your ordinary income rates based on the tax brackets for your filing status. So I'll run through some examples later. So that's the benefit of a qualified dividend, but what actually is a qualified dividend? Now, the full definition is a bit more technical than this, but to simplify things, a qualified dividend is a dividend you receive from a U.S. company, generally a U.S. company. Some foreign companies qualify, but generally a qualified dividend is a dividend you receive from a U.S. company on a share of stock that you held for at least 60 days. For common stock, it's 90 days for preferred stock, but most of the stock you own is common stock. So let's say in January you buy 1,000 shares of the ABC company, which is a U.S. company. And let's say that ABC company pays you a dividend of $1 a share a month later. So you got $1,000 in dividends for your 1,000 shares. Then let's say for whatever reason, you sell 200 shares in ABC company a week after you got the dividend, but you hold those remaining 800 shares for the rest of the year, right? In this example, how much your dividend income is qualified and how much is non-qualified? Well, 80% would be qualified, so $800, while 20% or $200 would be non-qualified because you held 800 shares for at least the 60 days, but you sold the 200 shares before the 60 days. So on the 1099 dividend, line 1A would say $1,000, line 1B would say $800. So what difference does it make on your tax return? Well, first of all, let me just say the obvious here, but if these dividends are received in a retirement account like a 401k or an IRA or a health savings account, an HSA, which is actually my personal favorite tax advantage account. If you've taken my course, you know why. But if these dividends are received in one of those accounts, then they don't get reported in your tax return. That's one of the benefits that those tax advantage accounts offer you, right? Because you can enjoy tax-deferred or even tax-free growth, depending on the account, in those accounts. But if you receive your dividends in a normal taxable brokerage account, then you do have to report these dividends on your tax return. And in the case of your $200 of unqualified dividends, these would be taxed at your normal regular income tax rate. So let's say in 2021, you're single and you make $30,000 a year from your job. That puts you in the 12% tax bracket, okay, even after the standard deduction. So you'll pay income tax at $24. That's 12% at your marginal tax rate, 12% of $200, $24 on your unqualified dividends. Now, what about the qualified dividends? Well, the qualified dividends qualify for a lower tax rate, the same tax rates as are on long-term capital gains. But check this out. Here are the 2021 tax brackets for qualified dividends and long-term capital gains for single filers. So this means if you're single and your taxable income, that's including all income, by the way, including the taxable dividends and long-term capital gains themselves. But that's also after you take your standard deduction or itemized deductions, your taxable income. Okay, so if you're single and your taxable income is $40,400 or less, then you pay a 0% tax rate on your long-term capital gains and qualified dividends for the year. So in this example I gave, where you make $30,000 a year at your job, you have $200 in unqualified dividends, you have $800 in qualified dividends, you would actually pay 0% tax at the federal level on those $800 in qualified dividends. They essentially flow to you tax-free. What a gift, right? And you can see for single taxpayers with taxable incomes above $40,400 and up to $445,850, the tax rate on qualified dividends and long-term capital gains is 15%, and for incomes above $445,850, the rate is 20%. If you'd like to see the qualified dividend and long-term capital gain tax rates for other filing statuses, check out the link in the description below. One more thing to know about dividends. If your combined dividend and taxable interest amount in the year exceeds $1,500, then you have to file Schedule B along with your tax return. But of course, your tax software would do that for you. By the way, quick plug for my TurboTax review and walkthrough. Check that out if you have not done so already. But yeah, this is how dividends are taxed, folks. There's not much more to it. There are some technicalities, but I think that's kind of beyond the scope of what I want to talk about here. Thank you so much for watching this video. Be sure to check out the videos on the next screen, which contain more useful tax information for you. And I'll see you over in those videos. Bye-bye.